Good morning, everyone, and welcome to our webinar on this fine, freezing February morning for our webinar titled, "Do you want to leave your pension to the taxman or your family?" My name is Gedalia, and I'm an audit partner here at Grunberg Co. I also look after a large amount of owner-managed businesses. As a firm, we've been running seminars and webinars for the last few years to inform, advise, and educate clients and wider public at large on various business and tax-related matters. As a practice, we have many clients that are either looking to build up funds for retirement or are approaching retirement and are unsure what their options are when it comes to the world of pensions, together being very concerned on the inheritance tax implications of the pension fund. You may be aware of the significant pension reforms that have come into place in 2015. They'll also have significantly increased individual flexibility when it comes to pensions and benefits in both ways you can draw down on pension funds, but also in the ways the pension wealth can be passed down to the next generation. It has, however, created a great deal more complexity, which can be overwhelming for people to navigate. In order to answer some of these questions, we partnered with Cavendish Brooke, an independent firm of pension advisors that we worked with for many years, to present to you today to help advise and guide you on the myriad and complex options the individuals face when it comes to saving for retirement and how to protect that wealth for future generations. Protecting that wealth from the taxman is the key topic of today's webinar. I have the pleasure of introducing Nigel and Cindy, and their colleague Graham from Cavendish Brooke will explain to us the implications of not thinking ahead with regards to how you structure your pension. And before I hand you over, please note that we'll be running a live Q&A at the end of this webinar and give you the opportunity to ask all those pressing pension questions you've been asking, be looking to get answered. Now, in order to participate, you'll need to click on the Q&A button at the bottom of your Zoom toolbar, where you can type in your questions, and we'll try and get through as many of them as we can at the end of the webinar. And we will also recording this webinar and will be made available on our website. And with that, I'll hand you over to Nigel, who will present with Cindy, and Graham will pop back in at the end to help answer your questions.
Good morning, everybody. Welcome to this joint session with Grunberg's. I'm obviously Nigel Goodman, and I'm the principal of financial advice firm Cavendish Brooke. I'm joined today by my partner, Cindy Griffith, and technical expert, Graham Angel. So good morning, and we hope you enjoy this webinar. Obviously, this first slide is the legals, and I've got to say that this information is based on our current understanding of the rules for the 2020 tax year. If you have any problems with any of the legals, then obviously you can get in touch with us. Next slide, please. So today, I'm going to give you a brief introduction to Cavendish Brooke, the new pension rules, what the problem is, and how we propose to solve that problem for you. Next slide. And the next one. Cavendish Brooke is a city-based firm of financial planning advisors with very many years' experience in all fields of personal and corporate financial advice. We provide a full range of financial planning services, managing nearly £300 million of pension investment funds for our clients. We've got about 450, 500 clients, many of whom are in a similar position to yourselves. We spend a lot of time getting to know our clients, and we base our service on not only technical knowledge, but most importantly for us, building strong relationships, getting to know our clients really well. This is the bedrock of the way that we do things. And it's important to us that the people we work with have the same attitude and want to work with us on this. We firmly believe that this relationship and the relationship we build, it's not just about price and doing things the most cheaply, it's about getting the best value you can for the advice you're getting. So let's start today by looking at the benefits of saving into a pension. I'm sure many of you today will be in a position to save more into your pension plans. The last 12 months or so have been difficult for many people and businesses. The health pandemic has been incredibly hard for families. They've lost somebody close to them, they've lost friends, and it's made life very, very difficult. Equally, it's also been difficult for businesses, particularly in the restaurant and hospitality businesses and travel, given social restrictions and lockdowns. However, it's been noticeable that these social restrictions have meant that many individuals have been able to save more and have spent less. And in particular, this is the higher income households and retirees, as you can see from the chart that's on screen now, if you move on. So you can see that how savings has increased, particularly from those people in the higher income and middle income brackets. Sadly, for those that have been unemployed and furloughed, they've had to call upon their savings. And interestingly, much of this savings is in bank and building society accounts, where the rate of interest payable is extremely low, in most cases less than 0.1%. So if you move on to the next slide, please. So I'd just like to do a quick poll with you to see how long you think it will take £100 to grow to the following amount. I'll just give you a few seconds. There should be something on the screen now, a few seconds to give me an answer. Based on the current instant access bank deposit rates, how long will it take £100 to grow to £125? Okay, so the answer is, next slide, please. We're still getting answers. As you can see, most of you thought 100 years, but very many 10 or 25 years. So the answer is 100 years. Next slide. And if you wanted to grow to 167 or 182 pounds, just look at how long it takes. Longer than all of us are going to be alive. Next slide. Now, the reason why this is so important is that many people have been urged to provide for themselves, i.e. invest in pensions over savings due to the poor interest rates that are on offer. One of the best benefits and the most important benefits of the greatest savings plan in the world, which is a pension, is that you get immediate tax relief. Next slide, please. Immediate tax relief on the monies invested. And you can see from this slide, the benefits of pension tax relief are fantastic. Effectively, £100 will grow to £125 overnight, as all pensions receive basic rate tax relief at source. And of course, if you're a higher rate or additional rate taxpayer, you'll be able to claim, using Grunberg's, of course, they'll help you get your tax relief back, but you'll be able to claim tax relief back from the HMRC, which can take about a month, or annually as part of your tax return. Either way, significantly quicker than the 220 or even 260 years. So, next slide, please. Let's now move on to considering the new pension rules and the freedoms that they bring and how they've improved. You can now access your pension immediately without having to buy an annuity. And in fact, it all started with George Osborne's budget in 2014, where unexpectedly he said that pensioners could draw down as much or as little from their pension pot as they wanted when they wanted. In fact, he said, no one will ever have to buy an annuity again. If you move on, please. There we are. So let me be clear, he said, no one will have to buy an annuity. So the new changes were announced in the budget 2014. They became effective in April 2015, and there were two main changes. The first was that individuals can access their pensions flexibly as much and as when as they choose, and do not need to access all the funds at one time. Previously, most individuals bought an annuity with their pot or were restricted by limits on income drawdown. Secondly, and even more importantly, individuals can now pass their residual pension pot to their beneficiaries on death. This means the beneficiaries can not only inherit a pension plan with all the tax benefits that they provide, rather than just cash, which would form part of their estate for inheritance tax purposes. So we will consider both of these in more details. Next slide, please. So, accessing pensions. As I said, the Chancellor will said at the time, no one will need to buy an annuity again, and they took him to his word. So within 6 months of the new rules being effective, next slide, the sale of pension annuities fell by 75%. In other words, very, very, very many people decided not to buy an annuity. And I apologize for this slide being 5 years old, but it happened so quickly, effectively within 6 or 7 months of the budget, and hasn't changed since. So what are the new flexible ways to access your pension plans? On the next slide. Okay, so the new flexible ways are that you can have flexi access drawdown, partial UF plus, full UF plus, and as usual with the financial services business, we like to complicate things, and our industry has, as with many industries, has so much internal jargon that it baffles everybody. But this decision tree shows the flexibility that's offered, and depending on and it depends on your individual circumstances how you use that flexibility. I know it looks complex, and quite frankly, it can be quite complex, but that's where we come in. And in conjunction with your accountants, we can work a path through, next slide, through the maze of options. So what I'd like to do now is pass over to Cindy Griffith, who's going to explain how you can utilize those options. Cindy, over to you.
Good morning, everybody. Thanks for being here with us today. A bit warmer than being outside, that's for sure. Makes pensions interesting. May I have the next slide, please, Joe? And the one after that. And the one after that, actually, because I'm going to talk about the pension death benefits. And what I'm going to talk about is leaving a legacy. Spend a few minutes introducing you to how tax efficient your pension plans can be for your beneficiaries when you unfortunately pass away. Now, obviously, that's a long time future. And hopefully you're going to live to spend most of them yourselves. But one of the bugbears through time has been that when we've passed away, our pension funds have gone into our estates and in due course being taxed. There's now a way around that. And through the completion of this particular form, the nomination of beneficiaries form, as long as it's completed correctly and in the right way, we are able to get around that issue. May I have the next slide, please, Joe? Pensions are always written under some form of trust. This is how we ensure that they are usually free of inheritance tax. And I say usually, normally might be a better word. You complete the nomination of beneficiary form, also known as an expression of wish. You might have come across that quite a lot in the past, particularly with company pension schemes. And this informs your pension trustees who should be a beneficiary of the pension plan. But it depends on the type of trust as to whether or not it works. Discretionary trusts, which tend to be what your older style pensions are written under, it doesn't work. However, the new, more modern pensions are written under a master trust, and the new rules are therefore most likely to apply. So our help is completing all of that with you to make sure that you've got the right type of trust, the right type of pension, etc. May I have the next slide, please, Joe? This has led to what we call like a pension family tree, if you like. So basically what this is saying is if somebody was to die with some money in their pension, it can pass to the wife, who can then pass it in due course to the children and the grandchildren and so on, so that the pension actually never really leaves your family. And by that, I'm not talking about the monies out of the pension, I'm talking about the actual pension itself. May I have the next slide, please? So we drew up two scenarios. Now, these are real life scenarios, not necessarily happening at the same time, but the first one, we've got Mr. Brown. So this is the two I'm going to compare are two people in the exact same position, but with two completely different pensions. So what we've got here is somebody who took our advice, I'm very happy to say, and found themselves in the following position. He died with £500,000 in an old, or sorry, he had £500,000 in an old pension fund or old style pension. He, however, took our advice, we're happy to say, and he moved it into a more modern pension plan so that he could access nominee and successor flexi access drawdown, which the old plan didn't facilitate. He unfortunately died in his 60s. At the time, the pension had grown to £600,000, which he then passed to his wife as nominee flexi access drawdown. She unfortunately was in poor health too, and she died 6 months later. She'd used some of the fund for care costs, so her fund was now worth £500,000, and she left that pension in its entirety as a pension to her two children in equal shares. So they basically have inherited a successor flexi access drawdown plan, split into two. Obviously, you can't have joint life pensions, each now worth £275,000. The withdrawals are tax-free because their mother died, unfortunately, under age 75. And basically, they can now, if they wanted to, if they haven't spent it, leave those pensions to their own children in due course as well. So I'd like now to compare that to another family, a family who actually found that, oh, there's a few extra costs involved in taking this advice, and we don't want to follow it. We'll stay with where we are. So we start with the same scenario. We have Mr. Jones now, £500,000 in his old style pension, didn't want to update it, and basically at the same side died age 62. His pension was now worth £620,000 because he didn't have any advice fees to pay. He had lower charges, etc., etc. However, when he died, passed it to his wife, but she now inherited it. She didn't inherit a pension, she inherited cash in the bank. So she received the £620,000, spent some money on her care costs, and ended up, when she died 6 months later, with £570,000. However, this is in her estate, and this is the key difference. It's not still in the pension. So she left 2 children in equal shares, and after the application of inheritance tax, they received £171,000 each. So if I may have the next slide, please, to summarise this scenario. Mr. and Mrs. Brown's children upgraded to the new style modern pension and inherited £275,000 each. Mr. and Mrs. Jones's children inherited some cash because the pension wasn't in the updated one. They only got £171,000 each. So that's the key point. Which person, which family, which parent do you want to be? Which set of children do you want your children to be, for the simple sake of making sure that your pensions are written correctly? So what does this all mean? Basically, we're really passionate about the tax benefits of modern day pensions, but especially the legacy element of it. Pensions are normally free from IHT, can potentially be tax-free in the hands of your beneficiaries. They're great rules, but the key takeaway point is they only apply to modern day pensions. So just as you update your car, you update your flat screen TV, your laptop, your mobile phone, we shouldn't ignore pensions, and we should do the same for that. So Cavendish Brooke can help you with that. Make sure, ascertain, first of all, you are actually in the right pension plan. We don't want to be changing something for change's sake. And equally, once you're there, you've got the right type of trust and you've completed the beneficiary nomination forms and successor beneficiary nominations correctly. Thank you very much. I'll hand back to Nigel now.
Thank you, Cindy. Now, it's important, or should I say, why is this important? So we would work with you, with Grunbergs, who obviously would know your inheritance tax situation better than we would, and your income tax situation. But inheritance tax is a really big issue. A lot of money is due to be passed down the generation. I have the next slide, please. A lot of money is due to be passed down the generations over the next few decades. As you can see, 5.5 trillion will be passed down in the next 30 years. And the government's expecting to receive annual IHT receipts of over 5 billion. That's a huge amount of money. And some of you may recall the previous Chancellor back in 1986, Roy Jenkins, who basically said, next slide please, inheritance tax is broadly a voluntary levy paid by those who distrust their heirs more than they dislike the inland revenue. I think we should say that again. Inheritance tax is, broadly speaking, a voluntary levy paid by those who distrust their heirs more than they dislike the inland revenue. So together with Grunbergs, we can help you address your own personal conundrum in this regard. Given that annuity rates are on the floor, as are gilt yields, as are interest rates, and as mentioned earlier, very few people now purchase an annuity. They prefer to have the flexibility and option to draw as much or as little as they want from their plans and when they want. And they would like, if possible, to protect the balance from IHT. This should form part of sound financial planning in the same way that you go to see your accountants at Grunbergs to make sure you pay as little income tax as possible and to make use of other allowances. The thing that we can do here with you is work with Grunbergs to make sure you don't pay this inheritance tax. And the thing that works against most people is time, not money. It's just getting round to doing it. So, next slide, please. In terms of the next steps, what are we here? How are we here to help? We'll hold an initial discussion with you to understand your personal position and to gather the necessary information we need to produce a report for you. This will enable us to complete a full review of our existing pensions and establish the current setup. If it's in your interest to consider moving your plans into a modern day pension, we will be able to facilitate that for you. Many of you may think you can do this yourselves, but it's actually quite complicated, and a number of the providers won't deal directly with policyholders. Obviously, we don't work for free, and you want to know what our charges will be. The initial discussion will be at our cost, so you don't have to worry about that. Thereafter, our fees will be dependent on what we do for you and would be agreed with you in advance of any work taking place. And in the modern world, you'll need to sign a fee agreement to agree to those fees. And every case is different, so we don't have a standard fee for a case. So I hope you found that interesting. Thank you very much for your time today. I'd now like to move back to Gedalia. Next slide, please. Now I'd like to move back to Gedalia's so that we can take any questions. Gedalia.
Thank you, Nigel, for that. And Cindy, that was very informative. Thank you for educating us on the pension situations. Now we have a few questions come through. A few of them are essentially all in the same vein. Essentially, Nigel, what happens if you're over 75 and you pass away? What happens to your pension then? What are the implications?
So the pot would pass to your next of kin or whoever your nomination, your beneficiary is. However, any income taken from the pot would be taxable. So the pot passes out potentially IHT free, but any income taken is taxed at your highest rate.
So it still gives a lot of flexibility. Obviously, it doesn't all pass tax-free, but it allows you to then still keep within the pension wrapper and only get taxed on it as and when you draw down on it, like a normal traditional flexi pension as it is for
exactly.
now.
The funds are still growing tax-free. And of course, if you don't need the money, you would have nominated your next of kin, whoever that may be. And should you die, they will then inherit the pot if you're under 75 tax-free, but if not, it'll be taxable.
And of course, in the meantime, the pension pot could potentially keep on growing.
Yeah,
growing in a tax-free wrapper.
Exactly. It's the family income tree.
Absolutely. So another question has come through is this applied to a SIP created over 30 years ago? So in terms of the restrictions in old style pension, I presume the question has been asked is when was the cutoff? Does this 30-year-old SIP still have the same issues, or would that need to be modernized as well?
Yes, essentially yes. So any old-fashioned plan, we would need to review the trust deeds of that plan to see how one can take the benefits of the plan. So whether it's 50 years ago, whether it's 20 years ago, we would still need to review that plan to see what the options are in retirement. Because a SIP is just essentially a personal pension plan that you control yourself and you can put other investments into to manage.
So another great question that's come in actually is, so with these pension funds that are passed on and inherited by the next generation, can the beneficiaries still pay into the pension? Can they still contribute to that, or is it frozen in time?
That's interesting. Graham, I'd like to pass that one to you.
Hi, good morning, everybody. So on that scenario, when you, so apologies for the technical terms, but when you inherit a nominee or a successor flexi access drawdown plan, you can't actually pay contributions into that plan. That's sort of the legacy, but you can draw from it. However, please note that those beneficiaries, those individuals who have a nominee flexi access drawdown plan, can actually invest in their own pension plan, and the normal rules apply on that. So there's no constraints to what you can do with your own pension plan, but you just can't pay into one of these inherited ones. You just have to set up another one, which is your own plan, bound by all the current rules around contribution limits, etc.
Great, thank you for that. That's essentially the end of our questions. If there's any more questions out there anyone has you'd like to have answered. Yes, another question has come in. So it's a great question. A few more questions come through. So what is the definition of old and new style pension? Is there a date when they changed?
Well, the big change was April 2015, when a flex access drawdown, taking it any amount of money you wanted from your pension plan. So in other words, old personal pension plans before then, what are known as Section 226 pension plans, which you'd know, Gedalia, through the work you do, any pension plan set up before April 2015, essentially, is considered to be an old style pension plan. So, for instance, I'm not going to mention particular companies, but there are companies we work with who refuse to change their master trusts. So the only options one has with a pension plan is to take it either all as cash, which you can do and pay your marginal rate, or part tax-free cash and buy an income. And that's the reason for switching to a modern pension plan.
Great. So I have another question on this over 75 issue. So the question is essentially asking, if they're over 75, what are the tax implications for the pot? Does it depend on how much you have in that pot, or is it just treated as we discussed before?
Not sure what you mean.
So I think that the question being asked is essentially, we already discussed, obviously, if a person's over 75 and they pass away, it's still, the pension itself still passes down to next generation tax-free. I mean, I can essentially answer this, to pass it down tax-free. It's just that when the individuals, the beneficiaries, would draw down on that pension, they would be taxed on that drawdown at whatever marginal rate of tax.
Their marginal rate.
Absolutely, but it makes no difference what the level amount in the pension pot itself, because the pension itself is entirely captured within the tax-free wrapper passed down.
Well, there would be a lifetime. There'll be a check on time limits at age 75. So if your pension plan happened to be £3 million, and you'd only protected, for instance, taken protection on your pension £1.5 million, there would potentially be a lifetime charge then at age 75. But thereafter, any monies, once that's been paid, drawn down, would be taxed at your marginal rate.
Okay, some great questions coming through here. I'll carry on. The only question is there any way you can protect the pension fund from being taken as an asset to pay for care home fees?
That is interesting. Graham, do you know the answer to that?
You can't, strictly speaking, you can't protect the pension from providing for your long-term care. Normally, what happens with local authorities is it actually forms part of your income assessment. So what will happen is so whether or not you qualify for care or not is dependent on sort of many things, but one of them is the level of your income. You can't just say, I won't take income from my pension, and therefore the pension is ignored from that purposes. What normally the local authorities will do is say what your pension would buy in sort of an equivalent, an annuity, and that would be used as part of your income assessment as to whether or not you qualify for care support or not.
Great, thank you, Graham, for clarifying that. Now there's another question that's come in from more kind of basic explanations of how the pensions works in terms of, are there limits to the amount that can be invested in the pension plan each year, and any tax implications?
Well, the current rules state that it's 100% of your earnings or £40,000, whichever is lower. But obviously there are circumstances in which one could pay more, for instance, by using something called carry forward. So depending on the level of earnings you have, and again, we would work in conjunction with Grunberg's here to advise on this, but depending on your earnings and depending on how much you paid in previous years, there could be the potential to pay quite a lot more than 40,000 into a pension plan as a single contribution in the particular tax year you're in, and there may be other circumstances in which monies could be paid into a pension plan. But generally, it's 100% of earnings or 40,000, whichever is lower.
Just kind of follow on that, building that. So because people may or may not be aware of this kind of tapering of the pension contribution. So how does the tapering work? What level of income does it boom?
So once the tapering starts now, between 200 and 300,000, the tapering goes down. So somebody earning about 200,000 a year would be able to pay £10,000 into a pension. But once you get over £300,000 a year, the annual amount you could pay into a pension would be as low as £4,000.
Right. Okay. So
Tapers
thank you for that.
down. It tapers down after £150,000. It goes down and down and down from the 40,000.
Okay, another great question I've got here is individuals worked in many companies over the year. How do they find out if they had a pension with them, and how do they access it? They have multiple pensions from different companies that they work with.
Is that an
Maybe
employed
Cindy
person or a
wants to answer this, maybe?
self-employed person?
Well, they worked for many different companies, and presumably everyone you join a company, you go into the auto enrollments, and you may be moving jobs quite a lot, and you've built up many different pension pots and from loads of different company pension schemes. And how they find out what pensions they have and how to possibly maybe even consolidate them, how do they access them?
Shall I answer? Shall I take that one? Basically, it's quite interesting. It's a very good question, actually, because the latest stat that I saw just last week, actually, that there are 19.6 billion pounds in unclaimed pension funds in this country for this very reason. And it's quite interesting. There are all sorts of tools out there. I think HMRC has a tool, and interestingly, those who read the Telegraph, they actually have a tool that they've recently launched as well to help you track down your pensions, and all you need is your national insurance number. So generally we would go back through your employees. This is how I work with my clients. Go back through the employees, the employers they've had over the years. We write to each of those employers and we get updated details on that, and if necessary we then also resort to using the tool.
Great, I think it's very, very helpful, Cindy. So another great question has come through. So if you inherit a pension pot from your parent, does that get included in your lifetime allowance?
No.
So essentially you can have your lifetime allowance, which is what's the limit at the moment, Nigel?
325. A lifetime allowance on inheritance tax or on pension?
Well, actually, the question, I'm not sure whether they're talking about the pension capital that they can put in themselves. Let's assume it's the allowance for pension they can contribute in their lifetime to the pension pot.
This year, 1,073,000 is the amount that you can have as a total pension.
So if you inherit £600,000 from your parent within a pension pot, would you still be able to save for your own pension with maximize that limit of £1,070,000?
Yes.
You could effectively have £1.6 million in a pension pot in this scenario.
As Graham said earlier, what you inherit is irrelevant to your own pension plan. So you can have your own pension planning, and you've inherited money that happens to be in a pension pot. You can build up your own pension pot. But obviously the inheritance tax limits, because the plan has been set up properly, would be outside of the inheritance tax threshold. So you could still inherit your 325 or whatever you're allowed, 650 if it's two parents.
So it's massive benefit and flexibility down the road. So the pension pot is not, as you said before, an incredible opportunity to save for your future, but it is an incredible way to pass wealth down extremely tax efficient down to the next generation. Because if everyone is contributing to their own pension fund and inheriting and passing it down, that wealth can build up and build up and build up for future generations.
Exactly.
Great.
I mean, there are lots of as Cindy would confirm, lots of ways when we discuss with clients, should they be using their pension to provide income, or should they be using other assets to provide income? And these are the things that we will discuss with clients when we meet with them. And in conjunction with you, Gedalia, we can determine, what a client needs to live on, and therefore which is the best way for them to take that money.
Brilliant. Some more questions come in. It's really great interactive from everybody. What are the benefits of a testamentary trust plan? If I pronounced that correctly.
I've never heard of that. A what?
A testamentary trust plan?
Well, 40 years in the business. I don't know, Graham, have you ever heard of that? Or Cindy? I've never heard of that. So I can't answer the question.
Okay, so I'm not sure what the question. Maybe if the person's asked, they want to rephrase it. We could try and tackle it again. Okay, so another question's come in. What would you recommend topping up? Would you recommend topping out one's state pension if you haven't made full contribution over the years? So for example, you haven't made
impossible question to answer, Gedalia, because we'd have to look at somebody's individual circumstances. So we couldn't just say, yes, top up your state pension without knowing the rest of their circumstances and whether that's the right thing for them to do.
So as I was saying, there's a difference saying it may be better for them to put into their own pension pot rather than topping up or making sure you're qualified.
Sure, depending on flexibility, the flexibility they want, as you know, a state pension dies with you. So you've topped up and then you die, that's it, you get nothing back. A personal pension can be passed, exactly what we're saying, can be passed to your heirs. So, you know, unless you really felt that you're going to live for 40 years and you know, whack the Inland Revenue and the government as much money as you can over the years, you know, we would need to talk to somebody.
Absolutely. That makes sense. It's personal circumstances, and there's obviously benefits either way, but it needs to be looked at carefully for each individual's circumstances.
Yeah.
Okay, so I got my last question come through here is, what if I had a pension with a company, say 30 years ago, and that company is now being taken over or stopped trading? How do I find out about my pension? How do I confirm that I had one in the first place? Is this
Cindy could answer that question.
It's the same issue as last time. Is the same essential
Similar.
answer?
If it's been taken over, that's easy. We contact the company that's taken them over. Pension funds are very highly regulated. You can't just dissolve them or spend them or whatever. So they're never going to go anywhere. It's just a case of tracking it down and finding what form it's in. It could have been bought out, if you like, by another insurance company where it's sitting there as a buyout bond or whatever. It depends on the type of scheme. But yeah, we can track it down.
Fantastic. More questions coming through. This is great. This is kind of, I think, this clarification on something we talked about earlier in the slides, actually, just to clarify the situation. So this person is concerned, if they inherit a pension pot from their parents, can they pass that down to their children outside of IHT? And if so, can you then do that during your lifetime, e.g. at the point where you're comfortable that you won't need it? So just explain, I guess the question is, which is one is the easy answer, does the pension pot that you inherit from your parents get passed down to your next children?
Yes.
Right. And then the question, that's an easy one. Yes, of course. But the question is, then they would possibly looking at transferring that pension that they've inherited, the funds in there, to their children whilst they're still alive. So is there any implications of that as opposed to waiting until they passed away before it's passed down?
Well, they take the money out of a tax-free pot to pass it to their children because they can't pass the pension until they've died. So if they're still alive, they would have to take money out of the pension plan to pass to children. Unless Cindy or Graham's got anything else to add to that.
I think I'd like to add.
Sure.
I think I'd like to add something, Gedalia, if I can, just because it's a great question that gives the potential to highlight even more flexible benefits of what can happen with pensions when someone unfortunately dies. And if we take that scenario, if we just rewind it back and assume that we haven't inherited our parents' pension, and there's quite a lot of talk. A lot of the questions have been about inheriting pensions, parents' pensions, and we just got to be careful that some of these, if these pensions have been set up under the old rules, the receiving of this now, it might not be possible. But if we think about it now in a modern day pension going down the line, but let's assume that we want to leave it, we do have the potential to inherit a pension from our parents in the modern day format. What you might want to consider is actually whether or not the grandparents of the pension plan holder, i.e. the children of potentially the person asking the question, are potential beneficiaries of the pension plan. And actually, you could structure it in a way that part of the money is left in the pension wrapper to the grandchildren on my parents' death, if I was asking the question, and that gets around that point. Unfortunately, you can't, as Nigel said, you can't sort of decide, take all the money in the pension and decide when you get to 55, 60 yourself, I don't need this money anymore. Can I gift away this pension now during my lifetime? Unfortunately, on the pensions legislation, that's not possible. Obviously, you can do that with other assets, and that's what you'll be doing, Gedalia, as part of normal inheritance tax planning with your clients.
Okay, great. Thank you, Graham. That was very interesting. So we have a few last questions, but most of them are quite specific questions to specific circumstances. And we're looking to wrap this up now. Essentially, if you still have more questions specific to your scenario, you need some advice. Obviously, we at Grunberg Co, together with Cavendish Brooke, are here to advise on those questions. So by all means, feel free to get in touch, and we can then have a discussion about your specific scenario and how we can help and advise you and make sure that you're properly set up for your future, whether that means structuring your income in a way to maximize the potential to contribute to your pension scheme, or obviously getting specific advice on your pension scheme. So I just want to end with Thanking Nigel, Cindy, and Graham for joining us this morning. And
Thank you all for listening.
This fascinating discussion on pensions. And thank you all for joining us here this morning and contributing these great questions and making this a very great interactive experience. As I said at the beginning, this webinar will be saved and is recorded and will be uploaded to our website. So you can view it if you missed some of the earlier sections of it. And of course, as I said, get in touch if you have any further questions. So thank you very much for joining us this morning and wishing you a great day. Take care.